To Beijing now, and an unusually frank admission from the Chinese authorities of the threat of a prolonged global recession. Vice Premier and Head of Finance Wang Qishan is predicting the world economy will slump and that China needs far-reaching financial reform to cope with the fallout. Well, I'm joined now from Beijing by Joske, Director of the China Forecasting Services for the Economist Intelligence Unit. Stephen, welcome to the programme.
Good evening.
Well, it's pretty strong words from Wang Qishan, almost alarmist, you'd say, that he says the only thing we can be certain of is that the world economic recession will last a long time. Not what you'd necessarily expect from the Chinese leadership.
I think it's actually a very realistic assessment of what's going on in Europe in particular, where there's, we're seeing regular bailout packages almost every 2 weeks. And political responses, but these crises just keep recurring because there seems to be a lack of political will for the sort of fiscal reform that could put their government spending back on a sustainable path.
You say Europe. It's, of course, the other big export market for China, the United States. We're expecting this Congressional Super Committee to announce later today that they've actually failed to cut $1.2 trillion off the federal budget over the next 10 years. I mean, how much do you see China slowing as a result of all this?
In fact, China's actually probably going to be less affected by the global problems at the moment than almost any other major economy. It's not an export-led economy. It's driven by domestic investment. It's got such a large economy of its own, fueled by construction, that it'll be able to ride out problems better. But that said, it will be significantly affected by an export downturn in Europe.
Once that is affected, I know a while ago you actually were, I think, the senior representative in China for the Australian Treasury. To what extent do you think commodity prices will be affected by that, and Australia be affected, indeed the Australian share market potentially be affected?
There'll be quite a direct effect, and we should see that quite soon. But I think the key thing for commodity prices in the Australian share market is the domestic Chinese housing cycle. That's what causes the demand for steel and iron ore. So the European situation is causing some bad sentiment, but the thing that will have a major impact on iron ore prices will be a downturn in the Chinese housing market, which is set to happen quite soon.
We heard a lot of talk, obviously, about the property bubble in China. How much of a downturn now or a correction do you expect?
Yeah, I'm always a bit cautious about using the term bubble because the situation in China bears very little resemblance to the US property bubble, which, of course, the US housing market collapsed in 2008 and has stayed down, hasn't really recovered at all. In China's case, there's very little borrowing for house purchase compared to developed economies. So it's not, and the financial system underpinning the housing market is fairly robust. So we're not looking at anything other than a fairly short downturn in China.
Last week we had the first IMF report on China, which noted that the banks in China could be severely impacted if a housing correction occurred at the same time as other risks such as capital outflows and tumbling equity markets. Do you agree with that assessment?
It's certainly true. Chinese banking system is best described as safe but inefficient, and I think that means when there is a downturn they pile up a lot of bad debts. But the good news is because the government owns the banks, you don't get what's happening in Europe at the moment. You don't get a credit strike when they're worried about risks. The government can just order them to keep lending. And in regard to the bad debts, the government does have a lot of fiscal resources it can put into bailing out bank balance sheets. I think it's a bit different from the situation in Europe where they're potentially going to run out of money to support banks. In China, the government has a lot of fiscal resources and further ones that it hasn't tapped into yet.
You appear to have quite a lot of faith in the Chinese authorities. Mr. Wang, I know, talked about some structural problems in the financial industry and Beijing needing to make monetary policy more forward-looking, targeted and flexible. What sort of financial reform do you think they'll deliver?
The key financial sector reform Wang Qishan's looking for is interest rate liberalisation, which means higher interest rates, a little bit higher, It also means a narrower margin between deposit rates and lending rates, which are now actually regulated by the government to guarantee bank profits. So we're looking for some fairly big changes in the whole culture of the banking sector to follow from interest rate liberalisation. Now, it's on the agenda. I think Wang Qishan and I think the central bank in China are pushing for it, but it hasn't got high-level political approval yet, and there's no clear timetable for it.
Do you think that they will be impacted also by this potential pressure on inflation that we hear about in China?
I think the inflation problem in China is probably less serious than some commentators suggest. I think it's clearly already peaked, and we've seen, I guess, about 3 inflation peaks in the last 10 years. All have been driven by food, and all have passed fairly quickly, and it now looks like inflation's coming down again too. The thing that's different this time is previously inflation's gone down close to 0, whereas now we're expecting inflation maybe 3 or 4% on average going forward. So it's a bit higher than they're used to, and part of that's because there's much more sustained wage pressure in China over the next decade. So Wang Qishan's right, they do need better monetary policy to contain that wage pressure.
Mentioned at the top that it was quite a statement that he made. To what extent do you think this might be a little bit of kite flying by the Chinese leadership, trying to gauge reaction on things like liberalisation of capital markets, bank competition, perhaps even the currency?
Yeah, it's very much an internal political battle within China. It goes back, I mean, China's had very long-term plans for reform of its financial sector. But if you go back to the global financial crisis, 2007-8, China was horrified by what happened to the US financial system and more or less put their own timetable for reform on hold.
Right.
And they're unsure of the correct model going forward. So I think Wang Qishan's trying to kickstart that reform process, which has been on hold for a few years now.
Stephen Joske, thank you very much for joining us from Beijing.
Thank you.